Winnipeg. Good morning, ladies and gentlemen. I'd like to call this hearing to order. We're going to acknowledge that we're in Treaty 1 territory and the home and the traditional land of the Ojibwe, Cree, Dakota people, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation in Treaty 3 territory. My name is Ron Merritt. I'll be being your chairperson this morning. Introducing the panel members, to my right is Mr. Ian Mahone, and to his right, Gisela Rempel, and our recording secretary is Stephen Lund. Representing the city of Winnipeg from the assessment department is Justin Mikulak, and Mr. Barocas. You'll be given evidence probably. Anyways, I don't have to read the Zoom because everybody is here. So this morning we'll be hearing application for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested has been described in each application, and will limit discussions to those matters. The statements that the applicant and assessor make at this hearing will be sworn testimony, and anybody speaking in these matters must be sworn in. Please be advised that comparisons of assessment properties are not considered evidence by the board. The board is appointed annually by City Council and is independent of it, along with the city administration. We make our decisions based on the evidence provided at this hearing and issue a written order that will be mailed to all parties as soon as possible. Please note the board decision in respect to application may be appealed to the municipal board if the matter pertains to assessed value or classification, or to Court of Queen's Bench, now referred to as Court of King's Bench, if the matter pertains to application from exemptions from taxation. Should you wish to appeal, information on how to do so will be included in the board's order. In respect to the hearing this morning, I will confirm the matters to be addressed with each applicant following the swearing in. We'll then have the assessor's testimony followed by questions that the other applicant may have, and then it'll be the applicant's testimony followed by questions. Each party will have the opportunities to summarize if they wish. Once all evidence about the application has been brought forward, where the applicant may leave, the process will repeat for each other item on the docket this morning. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the order by registered mail as soon as possible. This information, all public hearings are live stream recorded and will be part of the public record. I asked our secretary to swear in the assessors and to affirm Mr. Newfield.
Mr. Mikulak, please state your full name.
Justin Mikulak.
You affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. And Mr. Barocas, please state your full name.
Matthew Stephen Barocas.
You affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes.
Thank you. And Mr. Newfield, if you please stand briefly. You affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you. You may be seated.
All right. Mr. Mikulak, we're going to go to 597 Broadway. So the floor is yours, sir.
Okay, so we have file number 221924. Roll number 1209 126 8500, and the roll year 2023, and assessed value 1.549 million, classification 20, and liability is taxable. So it's 2 buildings, 3 stories, and effective year and actual year built, they range from 1917 to 1929. 40 suites, and the construction's masonry bearing walls. So if we scroll down through to page 3, you will see the income value summary and the income and expense workup from the model. So again, we have 40 units, 26 one-bedroom, 10 two-bedroom, with an average monthly rent per unit of $601.31. And then when we look at our model workup, our effective gross income at $279,393, with expenses at $189,540, to give us a net operating income of $89,853, and our capitalization rate of 5.8%. Scrolling to page 4, we got our rent comparables. So you could just see similar properties here within the area, how the subject compares rent-wise. So going forward to page 5, we got our capitalization rate chart. Just within the multifamily realm, you could see City of Winnipeg, we're with between 4.8 and 5.6%, which is the 20th to 80th percentile. And then scrolling forward to page 6, we do have our capitalization rate evidence, which I just want to make note of for you folks that there's going to be 3 sales removed from this chart. So we're going to remove 510 Burnell, 1833 Pembina, and 859 Grosvenor. Just we had found that there was some association with it where the sales couldn't be used. And so these sales will be used to support our ranges that we have on the previous page 5 for the multifamily properties, and they all had 3-year income stabilizations done to verify the cap rates that are used. So going forward down to, well, there's page 8. I just had dropped a outside picture of the property. Page 9 has their most recent income and expense statement. And then page 10 just showing their reported rents. So the subject actual average rents reported here would work out to $873.65. Our model rent is coming in at $601.31, well below the reported. And then if we go to page 11, I had provided just a little income and expense workup. So when we come up to the current assessment, it says it's 1.549 million. If we stabilize the expenses, we actually end up coming out to a value of 1.670 million. I had made an error on the cap rate. There it says 5.2%. It should say 5.8%. So that value would work out to 1.670 million. And our assessments coming in at 1.549 million. So we're not obviously giving a recommendation on the higher value. We're just showing that, hey, if we were to stabilize their expenses and using their income, what the value would be with our modeled cap rate. And then you could see in the green box, I highlighted just what our model NOI is, 89,853. And then compared to 96,916 once it's stabilized for the subject. The box in red, we excluded the maintenance and repair for 2019 because it was such an outlier. So when that is adjusted for stabilization, it still works out to 2,196 per unit, which is really still quite high. But so yeah, that's that's what we got here for this property. We feel pretty good about the 1.549 million.
I thank you. Mr. Newfield, question?
Yes, the valuation you're putting forward, page 3, then, was this all done by the model?
Yes,
And did you participate in the modeling that went created it? Do you know anything about it?
no, I don't work in modeling.
I'm just wondering about issues such as location, age, and condition. To what degree will they impact the modeling cap rate?
I don't have that information on hand directly to be confident answering that.
I can speak to that. I can speak to that actually. So we do have Winnipeg broken down into areas, and the model caps do change depending on what area of the city they're in. So that would have been something that would have been built into the formula that the modelers created in order to come up with the cap rates.
You know to what degree?
No, I don't.
And is age a factor?
I would think so, yes.
Do you know so, or you just assuming?
I would assume so.
Okay. I think after our last meeting, I think that's a fair answer. And was any investigation done on the subject property to see if it met the standards of the model in case of condition?
Can you maybe elaborate on that? What do you mean?
Did you
meet the model standard?
Did you do any investigation on the condition of the subject?
Property was not inspected.
Okay. Are there variables in the model to adjust it when condition is a factor?
Yes.
Was the stabilization of your models, to your knowledge, done in the same manner as was done on page 11?
On an individual basis, looking at the year by year, 3-year stabilized, we don't simply calculate, the model doesn't calculate value just based on what the owners submit, because often what the owners submit is either incomplete or sometimes there's anomalies in years.
Well,
So it wouldn't be, the model wouldn't do it that way.
no, okay, so it's a different process. That was my question.
Yeah.
Now, in this workup, page 11, I noted that there were 2 adjustments made to that I see. One was on the management, the other was on maintenance and repair from the averages. Is that correct?
Yeah.
And why didn't you put back in professional fees or office fees? Why are they at 0? Did you think that they don't have them?
Yeah, I know we discussed this in the past hearings as well. So that is a point. It might be the case where office supplies are built into R&M, where the overall supplies are often piled, or they're built into the supplies. We simply stabilized as reported. If you look at the management and the 3-year of it, 5% stabilization pretty much falls in line with what they're reporting. So we're really not too far off in that regard.
But there are no professional fees here. And would you assume that they would somehow incur professional fees on a property?
I mean, over the long-term basis, yes. But again, often when we see income and expense statements submitted, accountants just group categories together. We're just going off the raw data that they gave to us. That's what we can work with. If it was more broken down, we would be able to have a better look at it.
And at any point I'm looking at the form, and you didn't put in the signature part of the form, although I do have it. there's a contact number on there. At any point in your stabilization, did you contact the person who wrote it to ask those questions?
No,
In regard to the statement made on the maintenance and repair, I heard it was dismissed as an outlier. So I can assume then that no investigation was done on why the expenses were so high that year?
no, but one thing is to note is that when you look at the insurance amount for 2020, what they're reporting, it's gone up significantly. So there perhaps would be capital repairs built into that elevated 2019 R&M that would put the property in a, increased level of condition, for lack of a better term, and then got insured for more money. But again, no breakdown was provided, and I didn't call the number on the income and expense statement.
So again, this is an assumption that you think that maybe it was capital and maybe it increased the insurable value. Is that your statement?
Well, what I'm saying is that going back to your original question, is that figure is far out of line in regards to what we typically see on a yearly basis. So it's excluded. We stabilized using 18 and 19, coming up with almost $2,200 per unit, and still arrived at a net operating income with our, again, model cap rate, which you don't agree with, came up to a value higher than what the model is cranking out, and the net operating income on the model is lower as well. So I don't feel that we're making any overestimation of net operating income in this instance.
At any point, did you search for building permits or review the notes that were in your files in regard to the building condition?
Yeah, that would have been done. Often what happens is in the permitting process, renovations are sometimes done without permits. So it's not always a one-to-one relationship of whether or not, the renovation's been done or not. Also, looking at things in real time. This is 2019. Sometimes it takes us a while to update our records because we got a lot of properties to go through.
So you said it would have been done, and earlier you answered that it was stated that it was just kicked out as an outlier. So I just want to clarify this. At any point, did you review your property records on the condition issues on this building? Can you confirm knowing that you did it, or yes?
Yeah, no? Like notes were reviewed. We have this at a lower income quality in our model to reflect the fact that it is reporting higher than usual expenses over a long term. So that's something that we want to recognize. That's why we ask owners to submit mailers so we can get an idea of what's going on.
Okay, well, what did the condition say then, if you reviewed it?
Well, we have it income quality poor in our model.
Okay, but you don't know why, or do you know why, I should say?
Well, we got to check the notes here. Well, I personally haven't inspected. I don't see any notes on inspection, but they are consistently submitting income and expense statements with lower than higher than usual expenses. And that's something that we want to take into consideration. It's not a new building either. So we look at what the model is generating in comparison to what they're submitting, and we try to bring those in line over the long term, of course.
Okay, so you're nothing specific. That's all what I was asking. In regard to your comments on insurance, you said it went up. Did you compare insurance in 2020 to insurance in other properties over the same period?
I don't. Well, no. Well, I look at all the columns. This just stood out as an outlier. See how there's bigger repairs in 19?
No, there's nothing about the insurance now.
I know, but often we see after renovations, the property becomes more valuable, so it has to be insured for more, and then it costs more to insure.
Do you know who valued the property for insurance purposes?
No, I didn't consider that relevant.
Hey, you could ask me. Sorry, I just one second. I wanted to look at something else here before I move on from the insurance. I imagine I'll be able to deal with it later and not waste or take up time right now, but I'll probably ask you questions later about the insurance on other buildings. Now, is a factor in insurance liability?
Is that in my evidence today?
No, you said the insurance went up. So you've opened the door. I can ask questions about insurance. Is liability a factor in insurance?
Can you elaborate what you mean by liability?
Owner taking responsibility or being charged with something that happened on the property unrelated to the value.
All I know about the insurance is that it more than doubled in 2020.
Now, I'm asking about liability because I did a Google search yesterday on the number of murders that have taken place on this property or next door to it. And I have about 6 or 7. So do you think that an insurer would think that there might be a liability problem on this property?
All I know about insurance is that it doubled in 2020 after the year of major repairs.
Thank you. Sorry, those are my questions. Thanks.
Thank you, Mr. Hill. Ms. Rempel, questions of the assessors?
I have no questions. Thank you.
Ian, any questions of the assessors?
I have one question with respect to the capital rates or capitalization rates that you have on page 5 for the multifamily low-rise B, which I'm assuming this building would be in that category. Your 60% is 4.8 to 5.6%, I see from the chart. This capitalization rate is 5.8%, so it would be in the, to use a word that's been thrown about a fair bit today, and that would be an outlier. That'd be above the 60%, or that would be in the 20%, the top 20% outlier that's usually excluded from the capitalization rates. That's correct?
Yes.
What investigation, or do you do any investigation when the capitalization rate falls outside the standardized or the 60% percentile rates?
No, all our caps are done through modeling.
Okay, thank you.
Thank you. Gentlemen, I note that the subject property has got 40 units and there's no parking. Is that detrimental to the subject property?
That could be that's a fair comment. I would consider a parking situation in an identical property where it had 40 spots to be superior than no spots.
And the expense ratio is 67%. Is that about average for buildings of this age?
No, we've got it knocked down as low as possible in our model. So that's why the expense ratio is so high.
So the combination of lack of parking and high expense ratio, would that dictate the cap rate of what the subject is being evaluated at?
No.
At the 5.8? Any overrides there?
No.
It's strictly the model.
Yes.
Okay, thank you. Mr. Newfield, the floor is yours.
Thank you. So there was a slightly expanded scope in their presentation, so I'm going to slightly expand my scope of comments just to address what was said.
Can you maybe summarize it at the very end? Or do you want to go there now?
I'll go there now.
Okay.
And you haven't had the pleasure of seeing me this year.
That's true.
I think some of the other board members have. We're going to do a little bit more, spend a little bit more time initially, and then speed it up later.
All right.
Firstly, the comments on insurance were a bit of a surprise, and Colliers does their insurance valuation, and every year we get hired for the renewals. This property did not get a change in value. We didn't appraise it because they got an automatic bump in value from the insurance company of like 3% of value. Now, if the rates went up for different reasons, the rates went up for two reasons. One is it's a high crime area. As I said, there have been numerous murders in the building and on the property and in the neighborhood, like beside the building. It's just high crime, and it's a factor that the insurance company puts them on a high risk level. But the major problem they've had is stabilization of their foundation. So this also speaks to the expense ratio that the assessor does not believe nor investigated, even though I've reported it to them for the last 10 years. The foundation, the original foundation.
Okay, Mr. Phil, you're going into your almost presentation.
Can I segue into it and speed matters up?
Okay, all right.
So the original foundation, I believe, is rubble, and over the years they've had different parts of it collapse at different times. So we have a collapse in 2014, and you can see it on Google Street View. That was on the east side, and then the second collapse was in the 2019 expense year. It's just an ongoing issue, and it's I don't know if you call it capital repair when you have to fix a problem, because it didn't make it better. It just continues to stabilize a problem with the underpinning, which that when they've had a stabilization problem is that their walls collapsed, and so they could repair the walls, and the foundation hasn't been touched. So that explains the insurance number. They're put on a high risk for those two reasons. We also did submit a rebuttal package, and I'm not sure when I'll get into this, whether afterwards or
What are you rebutting?
Cap rates.
That's great. If you want to deal with the rebuttal, that's fine.
All right. So it was emailed yesterday.
Okay. We have to see whether we all have it. And it's probably at the end, but I don't see it there. I don't see it here. So Stephen will see to it that everybody gets it. So I just got it. Okay. What is it under?
Rebuttal 3 is the name, I think.
Okay, rebut 3.
Rebuttal.
Okay.
I updated it. So
Okay.
I've seen this once already. There's some new material.
All right.
I
have to send it to our
I think I had acknowledgement they received it yesterday.
Oh, sorry, Justin, do you have a copy of Cap Rebuttal 3?
Yes, I do.
Okay.
Okay.
And I did get page numbers on it too. Page 1 is just the top shows what the bonds and interest rates were, the graph as of the reference date. And below that is a calculation which shows what the return is required to pay your loan. And essentially, the best loan you can get, you still need a 5%, 5.09% return on for favorable financing to pay your loans. This property would never get favorable financing. It's in the market category. So returns are between 6 and 7% to pay your loan, just pay your loan. And my primary evidence will go back and reference this. The next 3 pages are just mortgage qualification. That's up to page 4 from different sources. They're all listed as where the sources came from. The first one is BDC, and in underlined and in bold that the primary need to get a mortgage is to pay your loan, not justify your assessment or your appraisal. That's why we have cap rates and rates of return. So the bank knows you can make your loan payment. It's like going to the bank and ask qualifying for your house mortgage. You gotta qualify, which means you gotta have enough money in your salary to pay your mortgage. For an investment property, you need enough income to pay your loan mortgage. It's simple. I've also included, starting on page 6, this is the textbook on expenses. And on this particular property, there is several areas that they did not bother to stabilize. And for example, page page 10 discusses maintenance and repair of the structure, and what it says in there, the basic is the expensing of it is on a case-by-case basis. So if you're doing capital improvements, it's not a repair, it's a capital improvement. But if you're repairing, it's the nature of the repair. Is it chronic? Do you anticipate it continuing to happen? Yes, we do. The operating expenses, there's an example of what's included on page 15 in terms of the typical expenses. And I was just looking for the quote about accounting fees and legal fees. I'll deal with it in another property where it's more pertinent. On page 17 is the above guideline increase, which are the standards required for above guideline increases. And when stabilizing a property's income, if you end up incurring expenses, then you have to determine in future years if you've got an above guideline increase afterwards. It's just part of the stabilization process. And you can see that in this case, we've really seen no above guideline increases. The only bump in income came when after the repair in 2019, and that was due to a vacancy loss when they had to vacate suites for the repair. So these weren't capital. The assessor brought up his cap rate examples, and this is still a work in progress. And I got to tell you where I'm at right now. His first one, which is still in his list, is 2390 McPhillips. It was sold by Ranjoy to a company called Skyline, page 22 and 23. And our preliminary investigation, we have a source that I can only present this to you informally, has said that it was a plus 5% cap rate on the sale. And I'm waiting to get confirmation of the exact number. And it was purchased by a REIT. And on that matter, I would take you to page 40 and 40 to page 43, which is from the IAAO mass appraisal. These are the standards that the assessor adheres to through their membership in the Manitoba Assessing Authors Association. They follow the IAAO standard. And in it, on page 43, acquisitions or divestments by large corporations, pension funds, or real estate investment trusts, REITs, that involve multiple parcels typically should not be considered for analysis. And there's a reason why. On page 25 is the definition of investment value. This is the textbook from our work, which is they buy properties to fill their investment. It's not market value, it's investment value. So whether it's 4.5% or 5%, that's not the relevant issue. And incidentally, their target investment rate on page 24 is 4.15% yield. So it falls outside the definition of market value. It's investment value. We will eventually get that number. 700 St. Mary's Road, another work in progress. Apparently, I know the property people involved in the property. They haven't returned my phone calls yet, but work in progress. 510 Burnell, which the assessor removed. We've had conversations on this, and the reason I suspect they removed it is because the information provided there is, I believe the statement was that there were the participants in the sale, they had concerns about having a business relationship. Now, the IAAO doesn't say you can't use them. It actually says, page 42, section 5.3.5, corporate affiliates, is that you then have to look at the factors and determine whether or not it's a valid transaction. You don't have to dismiss it, just have to do more work. We did the work because Brian Talue in our office sold the property, and his workup on it is on page 27. So in their initial calculation, they had a 5.2% calculated, and that's based on carrying a 3.25% loan. This is the initial workup presented for consideration. And you'll note that under investment summary, which is about the top third of the page, left-hand side, we had costs after, or closing costs added to that, which artificially changed the cap rate. Removing those closing costs to provide a consistent calculation, which I've done on page 30, indicates that that would have been 5.36%. However, before the sale closed and during the due diligence period, the purchaser was able to obtain a low interest loan through Sandwich City. And this is called preferential financing. So on page 30, oh, sorry. The other thing I wanted to show you about this sale was the income varied from what the assessor is using. And I have all the sheets that were supplied. And you'll note that the income used varied from 246,000 to 277,000, yet for sale they used 316,000. That's why I was discussing the residential tenancies branch, because in this case, if you look back at the statements, that there was a fair amount of deferred maintenance corrected, which then allowed them to apply for an RTE above guideline increase. And those are stated on page given through this before, and your page 17, which shows, you know, the guidelines. How do you get an above guideline increase? Increase or decreases in operating expenses, capital expenditures. So they got their above guideline increase. So at time of sale, between the time that they sent in their last mailer and the time of sale, they had their above guideline increase approved. So all of a sudden we have an upside in income. And that's the other thing that the model never identifies or looks at, and the assessor doesn't look at. So it's been stabilized on the basis of at time of sale. Between the last time they saw a statement, things change. And that's the dangers of using old statements to try to work out caps. The next issue, as I said, was the beneficial financing. Now the standards for CMHC financing are in here somewhere, and it's not available to anyone. I couldn't get it because I don't meet the criteria. One of the criteria is experience in managing properties, 5 years, which the purchaser had. Having the cash to make the payment for a full year without income from the property is another one. So I couldn't do that. I don't have that sort of cash to make the mortgage payments. So the normal person couldn't get this. Now, there's a formula on page 46, and this is from the Appraisal Institute. This is how you calculate the impact of creative financing, as we call it. And that's simply to take the mortgage constant at the 1.95%, compare it to the 3.25%, and get a ratio and adjust the sale price. So essentially, if you were using this property to present to somebody as a normalized rate, it actually caps at 6.05%. And that's on page 30. That's the analysis that in the private sector we would be using to analyze the sale and stabilize it. And we go out and ask questions and talk to the people who sold it, the people who bought it, which we had in all those cases. The next sale that I was reporting on is 203 Bertrand, and there's a listing, and that was renovated after sale. So it was not a sold on the basis of its current income. It's a project building. Yeah, not valid. 677 Maryland is in the assessor's study. It's sold several times. And we had two listings, one from 2014 on page 35, which showed net income of 204,000. The other on page 36 from the year 2020, which was the sale year, saying that the net income is 175,000. Now the assessor's calculations fall well short of that. So this is what's in the public, well, on the MLS site provided. Now, whether the numbers held or not, the issue was you're supposed to do your due diligence and check into this. Also on page 37, the property had a with 30 years remaining on this rare CMHC mortgage in the low interest rate environment. 2.145 million still had a low interest rate on the rare mortgage. So again, begs the question, did you adjust for preferential or creative financing? And that's what we're finding as we go through these. I don't have any information yet on Arden and or 555 Corridon. I know Corridon was bought by a major apartment holding company. I'm not expecting to see anything funny on that property, and the rate kind of supports that. For some reason, it's in the mid fives, where some of these other ones are showing the fours, and the reason is that they just got it wrong. Page 39 is a letter our company wrote to the city assessor, and because of issues like this, we just asked them to stop quoting us, because if you don't do the due diligence, don't report what people in the market are saying, because it's not right. And you'll see in my evidence later what I mean by that. And you know, I've got no complaints about the assessors today. I think they understand the issue, and if I had reminded them, they would have probably done something about it. The danger in using outside reports is that you got to know more about them and look at all the backup data that's in there. Page 47. Now this is presented as rebuttal information, so I'm unable to present these as primary evidence of cap rates. What I can say is that the source document I got this from, this is what Colliers does. This is what I can speak to. If we find a renovation sale, we don't give it a cap rate. So you can see in this that we had 4 that were listed as renovation projects. Those aren't cap rates. That's the way the market does it. We've got to say to people, this is a renovation project. This income was not relied on to calculate a cap rate because there's other things that are play. And incidentally, page 49, I can discuss because our appraiser had a cap rate on 203 Bertrand at 5.37%, as opposed to what the assessor stated on it. Being 4.77%. So I can't say that in rebuttal. They got that one wrong. But I don't want to pick on them or say it's not personal. Their system doesn't work. You don't take flyers that you get from the owner and then 18 months later convert it into a cap rate, and you don't make adjustments without verification on certain things. Why did this happen? The dates are wrong, and the if you see an influx of capital or higher R&M costs, you should be looking for residential tenancy board over above guideline increases on the next years, because that's the way the market works. That's the rebuttal. Now I'll move on to my.
I'll see if, thank you, Mr. Neufeld, if there's any questions by the assessors of the rebuttal. Gentlemen?
Yes. So page 27, Burnell. Even though we excluded this from our cap sales, there were some comments made. When you look at the workup here, operating history, I see 2009 caller's projection, 2019 actual, 2018 actual. When you go to repair and maintenance in general, you could see how the Collier's projection is out of line with what they had previously reported. Is it reasonable that a purchaser would expect such a change term in R&M?
Your assertion is incorrect. The history of the building is that in the years leading up to the sale, and I've listed them on page 29, that the R&M were higher in anticipation of a sale. And the owner, which is an estate, had always divesting themselves of this property. And over in the 5 years prior, they had spent money starting in 2015 with the new roof, and then beginning to look after the deferred maintenance that was in place. And also, if you note that the 2017 year was actually below the Collier's projections, that was a year when they just spent a nominal amount of money. The principle here is that they were fixing it up to get it ready for sale in order to get a higher price, which is common, what everybody does.
In the past, you've stabilized at 1,500 a unit. Would you not think that that would make more sense?
Well, the people who stabilized this inspected the site and looked at the quality of the deferred maintenance, made some long-range projections on what they anticipated over time. So if your deferred maintenance has been cleaned up, then you can go with the lower estimate. And that's what the professionals in our office do for a living, is they review this. And you know, this wasn't a posturing whatsoever. The people who do this, Brian Talia and Don White were at the time, and Ron Sushi was their analyst. They don't present misleading numbers.
Are there any professional fees estimated in this chart?
They would be admin in general and management fees put into there.
Okay. You know what the actual R&M has been for the purchase?
Well, I've listed the history of it on page 29. It was high, leading up to the sale.
Okay, I'll just leave it there. Let's see, going down to going down to page 32, 203 Bertrand. Would you agree that based on the reference date we're looking at, that's post-reference information is thus inadmissible?
Yeah, I don't think there's anything in here that we're relying on. It's when our it's kind of a standard that we put in the history, whatever we can find. So I don't think anything turns on this.
Okay. Then looking at page 35 and 36, I'm assuming you've looked through lots of MLS attachments in the past where the realtor presents a pro forma and a calculation of NOI. Would you agree with that statement?
Yes, I've seen a fair amount.
Okay. Now, would you agree that often the realtor doesn't, I don't know how to put this, do the best job in stabilizing the historical income and expenses and coming up with a sale price for their client?
If a realtor misleads somebody, they face sanctions from the Securities Commission and from civic action.
So what I was asking was,
They don't care to be misleading. There's severe consequences to it.
no, but what I was asking was, have you ever seen a case where, you know, the income and expenses don't actually reflect the historical actuals on attached pro formas on MLS?
No, not really. I mean, I think the comment I made earlier is applicable in that there's history from the last time a statement was made, and then there's recent history. And if you're going to do evaluation of any property, you don't put your blinders on and look at statements that are older. You look at what's happening today. So all the time I've ever stabilized numbers, I look and I see a high R&M and I start with, what did you do? And I find out what they did, and then you do a physical inspection of the site and you say, well, okay, they fixed something, and that's not going to happen again. And then we go on to the other things, and we look at income. We say, what's your income been? We look at it and said, did you apply for RTB this year? Yes, no. Did I get above guideline? I mean, I think that those are the key elements. Is that you don't sever the analysis as of the date of the last financial statement. You sever it as of the date it goes for sale.
Okay, and page 37, listing closing after the reference date. Would you agree that this is not post-reference information as well?
No, it's not post-reference because that was when it was closed. So this came from a listing that was open, and I believe it was the one listed on page 36, which shows a listing date of February 14th, 2020. And I didn't put the whole history out, but then this was extended and then eventually withdrawn at some point. But this is from this original listing. And why I don't have this information is there are tabs on here that you can only get into as a realtor, and I'm not a realtor. I'm an associate on the MLS, so I can't get these tabs that show floor plans, map, and the rest of it. So this would have been an attachment to that listing from 2020, to my knowledge.
Okay, and just one more question. Are you aware that no other applicant has presented the financing method in regards to calculating cap rates thus far, the Board of Revision?
Why would you question me on other people's failures? We do the market. We know the market. We sell properties. You know, we don't appraise them or value them or fight tax appeals alone. We manage them, we sell them, and appraise them.
Okay, so to your knowledge, you're the only one who's doing this method?
I have no idea what other parties are doing. Someday I'll share with you some nasty emails if you want to satisfy your personal curiosity.
All right, those are my questions.
Thank you, gentlemen. Ms. Ripple, any questions in regards to Mr. Newfield's rebuttal?
No, I think my questions have been answered.
Wrong? No. Mr. Newfield, the floor is yours.
Thank you. And next ones won't be this long. This property built in 1917, and I think I heard the assessor call it two buildings. they're attached, so it's two sections, not two buildings, a minor point. That they can't be severed, and when one collapses, like I told you, the east side collapses, west side dies with it. The issue we've had with this is in the 14 years I've been working for this property owner has been the two major ones have been the stabilization of the underpinnings, which has never been done, and their costs have been related to wall failure. Now, I know that in these statements, at one point, there was a roof repair, and we didn't take that into account. What we relied on was the 2020 statement, which is more of a normalized statement for a very high maintenance building. Problems with occupants and collection. If you Google a map, there's a city map that goes murders by location in the city of Winnipeg, and it clusters around the property. Now, it's unfortunate, but you know, this is also something we have to deal with in valuation. This is a stigma attached to the neighborhood, so you're not going to get the best of tenants in your building, which is going to give you problems with collection, with ongoing repair and maintenance. It's a fact of life, and so it's just not a great location, and the building has problems. We're using, you can see we presented you the income for 3 years, and 2018 was a good year, 19 was a horrible year, 20 was an average year, and we ended up relying on 20 at 80,256. Looking at the statements on page 3, that is the number they provided. So I've been reading their statements for 14 years, and these are statements of actual income and expenses. In this case, I agree maintenance and repair is high, but I don't think it's an anomaly. It is just a fact that we have to live with. Over the years, it's always been in this amount, this amount. It's still turning a positive cash flow, and I guess that's all that really counts. Now, as to capitalization rates, page 18 is now included in all our capitalization rates. The world has lost sight, not the world, but the city. A lot of people have lost sight of why capitalization rates exist, and it's to pay the mortgage. It's not difficult. It's not complicated. There is a linkage. Now, what the Collier's cap rate study is now doing is reminding people of this linkage. We're trying to say, no, 4% doesn't exist because you can't pay the mortgage. And I'll show you that later on. Now, page 19 is the 23 points that we use to adjust and some explanation for them. Page 20 is our Collier's Quarter 1 2021 report. And you'll notice page 21, we're now talking about trends between the relationship between bond rates and bond yields and cap rates. This is the cornerstone. Now, earlier on, when I was bringing this out, I was saying this is going to be our, this is what we're going to be relying on. But the point is, what we use it for is to vet investment sales. Is this real or is this not? And this, it's like when we used to do mortgage equity as an appraiser, we always had to do one to prove that you could actually pay a loan you're requesting. And Colliers nationally, not me, are reminding people that there is a relationship, don't violate it. Page 22, what's of interest is that if you look at the average cap rate, they're saying 5.5% for most properties. And this is a national number, national chart here. And that's good properties. Page 23 is the Winnipeg report. And some of these are estimates. For example, office, completely estimated because there was only one cap rate office sale in this period. So that doesn't help anybody. And the definitions, we've upgraded them on page 24, multifamily, right side column. they do not include poorly located, foundation crumbling, high crime areas. Our caps are for good properties, not this type of property. And our disclaimer, page 26, user is required to conduct their own due diligence and verification. It's just a shot. The city, please pay attention. Don't quote a report if you don't know how it's made. Page 27 is our new debt advisory services. Now, the newsletter is dated August 21, so there is some post-reference information, but you can just look at the graphs because they're historical. The concept is the linkage between interest rates and cap rates. Collier's national publication, incidentally, the analysts who worked on this are based in Saskatchewan, and a very similar market in many ways to Manitoba. And they're just the reader to be informed how you have to look at your cap and the interest rate. Page 29, for example, shows a variety of different interest rates that were available at the time of this publication, and you can see that for example, the CMHC rates were 1.5% as a low, as compared to other sorts of financing, which were in the threes, as Brian Talio's report showed on Burnell. So that's preferential financing. And so this takes us back to our cap rate analysis on page 2 and where we come with this. So the best rate is 5%. Now, Winnipeg will never hit the best rate because Collier's includes closing costs. So we've made an adjustment of 3 basis points, which approximately equal 3 points, which equal about 0.5% basis points. So what we're saying, that my adjustment of 3 points works out to the lowest cap you should see is 5.15% in our standardized analysis. The problems with this building are obvious. No parking, we've already heard. That's a further deduction. Design and layout, bachelor's is bad. Year built. Obviously, very major issue here. Quality and condition is the underpinnings, and the cost of maintaining it every year are obvious. And income stability, which is related to having vacancies while you repair a wall or while you clean out a unit that's the scene of a murder. I'm just being overly dramatic here, but it's the truth. So, I think on a good day, our 6.75% is probably a lower rate than this property really deserves, but we're trying to stabilize it, and that comes up to a value of $1,189,000. And I believe that the 2020 assessment is still under appeal, and it's the same issue again, where I don't have the data in front of me, but I do believe it's still being debated under case management at the municipal board. That's my presentation.
Thank you, sir. Assessors, any questions?
Yeah, just in regards to the foundation damage, do you have any pictures of the alleged foundation damage?
I have some repair pictures that I got yesterday, and I didn't make them into PDF. So I have the pictures of the repair being conducted on the east side, and these actually were on Google Street View. So if you check Google Street View 2014, you'll see that they come up. June and July of 2014, that was the east side underpinning, and then the roof was fixed. One roof was fixed in 14, the other roof was fixed in 19, and there was other structural work done on the property, which I couldn't get in Google Street View because it was west side and it abuts another property. So
Do you have any documentation of quotes or anything like that for costs to repair?
they were provided in 2016 and 2018 deals.
And then just on page 2, that chart. So is that something you just made up on your own, or does it come from a textbook?
The chart originated with Colliers in conjunction with all of their valuation modeling, where the original genesis of this was that it was done in a qualitative basis, which is the 23 points, and the ranking that was done in 2008 was similar, superior, inferior, and then this led to a quantitative analysis and conclusion on cap rates. In 2010, at a meeting, Collier's valuation in Kelowna, we discussed the qualitative analysis that you now see today. So a paper was circulated on the ratings, and we had a national review, and this is what came out of it. So it's corporate in that respect, and as a member of the national, I don't know what I am these days, something national, something or other. I do have a say, I do have input, as do the other national leaders. But we're not, this isn't made for, this isn't a single person's job output. This is our attempt to be transparent. And the best part of it, I think, is when you present something like this, if it's in an arbitration context, the people listening to it could disagree or agree and make their own adjustments rather than base it on something they haven't seen, like, an assessment model.
Okay, we're good here. Thanks.
All right. I thank you. Ms. Rempel, questions?
Yes, I'm just wondering, do you think that there is an unusually high vacancy rate at this property in terms of your experience?
Well, it's got some severe turnover issues in relating to the repair. So, for example, when the east side was knocked out, they cleaned out everybody on an apartment on that side, and I think that overall, though, this is probably one of their highest turnover buildings in their portfolio of 100. It has point of time from impact of repairs and external issues, and also turnover on from a normal basis. I think what we're generally have in this neighborhood is a lot of social assistance recipients, so they tend to have a higher turnover in their buildings.
So you think it's a high turnover rate for this particular property in terms of the properties that you have been involved with?
Yes, and in terms of their portfolio, it's one of their worst performers in turnover.
So
There's other ones today from the same ownership who you can see were more stabilized.
how about other owners?
I think that this part of town is problematic. I've worked with a few other owners on their sites, and the social assistance factor is, I guess people sometimes hesitate to discuss, thinking it's not politically correct. It's just a fact of life. The rents are guaranteed by the agency on social assistance. So it's not a question of them getting, not getting the cash for their unit. What it is a question of is when a sudden vacancy occurs and then the downtime on a unit to repair the damage, which can often exceed the damage deposits. I think that's the greatest problem they face. And that's why you see a high R&M cost.
I used to be responsible for social assistance for the
Okay.
province, so I understand entirely how that works. So that would mean that probably they would get the damage deposit from the province as well.
Sure. And the damage deposit was $250 on a $500 rent. And they spent $1,000 repairing the toilet and the sink and the fridge. That's just the nature of the business. On the other hand, if they can do it very, very quickly, you know, the province sometimes double dips on payments too. So you see that in occasions where, you know, your tenant pays the first month rent through social assistance and leaves halfway through. You can turn it over in a week's time. You get a second tenant in before the end of the month and you get a double rent. That's in a rooming house. Usually you'd see that, but in a place like this, the downtime is they're a very good operator, and so they always have to go through and redo all the units for the damage.
So you indicated that they're turning a profit, and
Yes.
that's all that matters, really.
Well,
I think those were your words.
yes, in the long run, they are turning a profit. It's not optimal, but you know, it precludes them from thinking about alternatives. So if you're losing money, then you start thinking about redoing this in some way. In this case, given the underpinning problem, it would have to be a bulldozer and reconstruction, and then they have to deal with the heritage issues and the affordable housing issues, and the rest of those issues. So right now, it's more of a let's just carry on with the operation, and they have several buildings that fall into this category. I was at the board with one last week on McMillan. It's the same idea except a better location. And it's and then there's another one coming up today on Colony. But out of their 100 buildings, those are the major ones with problems.
And I just have one final question. Can you tell me how the murder rate at this particular location compares to other locations, say Maryland Street, for example?
Well, it's half a block from Maryland. So
How about Maryland North?
Maryland
Dulles?
North. I should have brought the map. I maybe brought it out. I have, all I did was we had the news stories here, and the last one actually occurred next door on the lot. But in the history, we've had a man fatally injured. That was in the lot next door. And then in 21, there's a picture of their building in the background. And in 10, it was, that was nearby in Colony. I don't have a date on this one. This one was at the site, and then in 2014, it was just a car crash into it, and then 2014 shooting. So it's been. I think the reason you would bring it up is that you wouldn't be finding people who are. What's the right euphemism? The working poor or people with any families looking at this building as a great place to live. And it's going to get you a lower, I don't want to use the wrong words, or quality, a lower socioeconomic class of users, and you're running into, I think, the high costs of maintenance.
Okay, thank you. That's all my questions.
Thank you. Mr. Rahal?
Yeah, on page, your 23-point chart on page 2 or graphing, that's a Collier's document.
Yes, it is.
That's not an industry standard document accepted by the Association of Characterization or Calculation of Cap Rates.
Our standards from in the Appraisal Institute don't extend to formulas. So they would say a reasonable method of valuation. I've never had them review it. I think it's outside accreditation. I'm an accredited appraiser with the Appraisal Institute.
Thank you. That's my only question.
Thank you. Mr. Newfield, I have a few questions for you. I see that I'm just looking at your first page, and your average rental NOI,
Yes.
okay, about 53,000. Yet you come along and you stabilize at 80,000. How do you get there?
Well, what we did is we just looked at the last year of 2020 because 2019 was impacted by very high repair costs that year. And the year before was a year, I think sorry, I got distracted by something. I forgot to pay for my parking, and I hope that no one
take care of that.
no one from the authority is watching this in case they say we should have given you a ticket a while back. Okay, pay by phone. So this will take 5 seconds.
Yeah. Mr. Newfield, do you want to, we have about 5 minutes?
No.
All right.
It's pretty simple. The expenses that occurred in 19 were paid in 19 were incurred in 18. So just thought that both years would have been impacted by a regular amount of costs. I forgot to bring my file. Well, it's gone all digital, so I usually have my files with me, but this is very consistent. The 80,000 is what they've been earning.
The old assessment in 2020 is at the municipal board.
It's currently in case management.
Case, well, that's at the municipal.
Yeah, and
and does the property, I think I've sat on this before, and there's a constant problem for the underpinning of the building.
right.
Okay, so in total, what do they spend per year, or what is the average over the last sort of 5 years? What they've spent?
I have forgotten my file.
Approximately.
It's repairs. I would guess somewhere in the neighborhood of 80 to 120,000 a year has been the ongoing costs related to that. In some years, it's lower than others. Some years it's greater, and it's repointing and straightening and replacing certain fixtures.
So I'm looking at the city's cap rate and your cap rate, and it's about 1% higher. So is that justified in regards to the location and the crime rate and the underpinning?
Well, I think the biggest issue is going to be that when you have a chronic problem, it doesn't go away. So that's a cap rate issue. So you know that you're buying it, you're not getting a steady stream. You know that you're buying a risk level down the road. That'll be the major issue. And then the secondary issue is, yes, the location. It's not, it's like someone saying, I've got a rental property in San Diego, or I've got one in Winnipeg, and the locations just have different values, different expectations. And basically these expectations are the upside, the property growing in value, appreciating in value. West Broadway does not possess the ability to appreciate in value, which is in the buyer's mind on a cap rate.
So eventually, when expenses get higher and higher, when does the expense ratio get to a point where it goes to land value?
Well, what they would do is they would reach a point where they would envision a new project, and the cost of the new project and the anticipated earnings on the project, and would the capital would the recovery on the capital exceed the current income, and then the legal difficulties are in it. Anything built in 1917 and anything that's I think the affordable housing problem would probably get resolved with a condition report, and if they're building a similar structure and replacement. The historical one, that's a question mark as to whether they would get approval. I think that the archway is protected. Yeah, the front and the courtyard, the archway is protected status. So it would be I mean, there were a way of saving it and rebuilding back maybe, so that brings the costs up and the returns are higher. So I would guess that 40 units, it's going to cost probably 5 million to build something new in that ballpark, and then you'd have to get recovery out of 5 million, so you need to be generating they would target 450,000 for income, and then maybe you get a little bit less than that even if they got 300,000 in income. And then the difference on paying the mortgage and that will then exceed the 80,000 they're currently generating.
All right, I thank you. Summation, gentlemen?
No.
No? Mr. Neufeld, summation?
Yeah, I don't know how you can do a hypothetical income on this. It is what it is, and there's no such thing as stabilizing something like this, and cap rate has to take into account all risks. Thank you.
All right, we're going to take about a 5-minute break. So we'll be back in about 5-6 minutes.
Okay.
We'll call the meeting back to order. So now we'll go to the next property on the docket, which is 239 Colony Street. Mr. McCulloch, whenever you're ready.
Okay, we have file number 221928 and roll number 1209150800. Roll year 2023. The assessed value 1,428,000. The classification 20 and is taxable. It's a 1 building, 3-story, actual year built 1939, effective year built same 1939, 29 suites, and the construction class masonry bearing walls. Just a picture of the subject's location here. You could see just west off Memorial, about a 6-minute walk from U of W. And then if you scroll down, we did put forth a recommendation that right now we're gonna revise lower. So we did make a mistake in our workup on page 11, that you could you could disregard this value on the brief, and the new value would be using their effective gross income at 182,611, which was stated on page 9. And then we stabilized the expenses with their 3-year actuals and used the 1,500 per unit R&M for repair and maintenance to come up with the expenses of 119,444 and a net operating income of 63,167. And the new rounded recommendation would be 1,019,000. So 1,019,000.
Cap rate?
And the cap rate would be 6.2%.
Mr. Newfield?
I wish I would have seen this earlier. I would have gotten a hold of the owner to ask him on this call. I'm reasonably pleased with it, but perhaps I'll just debate one point and then leave it in the board's hands, if that's okay. And it's just the repairs and maintenance.
So are you in agreement, Mr. Newfield?
No, I'm sorry.
All right.
I don't have that.
Okay,
I didn't get the go
that's
ahead.
fine.
But I'm just saying that,
Okay.
I'm willing to restrict the debate to the one issue.
Mr. McCulloch, that's your presentation?
Yes.
Mr. Newfield, any question?
No, what, forget it. It's fine. We'll take the recommendation. That made me think about it here. I'm just, curious. We got a better building than the last one, 6.2%, and the last one's 5.8. So I wanted to be able to say that in summation. So I just slipped it in anyway.
So you are accepting the recommendation?
Yes.
All right. Panel members, any questions?
I have no questions. Thank you.
All right. So be it. So we'll go to the next property, which is 800 Corden Avenue. Mr. Assessors, whenever you're ready.
Okay, just give me 1 second here to.
Yeah. Okay. 800 Corden.
Right.
So whenever you're ready.
All right, so this is file number 222721 and roll number 120-226-70300. And the roll year is 2023, assessed value 11,658,000. Classification is 20, liability is taxable. So we have 2 buildings with 10 stories. The effective year built being 1981, actual year built 1971, 80 suites and construction class masonry bearing walls. So going to page 2, I have provided just a little map of the location of where the subject is. So it is just south of Corden Avenue. You know what? Can't really see the cross streets, but it is about 1, 2, 3, 4 blocks in from Pembina Highway. Scrolling further to page 4, we have our income value summary. So you could see the average monthly rents work out to 1,204.74 a unit. And then our workup from the model being effective gross income 1,107,975, expenses 513,436, to give us a net operating income of 594,539, and a capitalization rate of 5.10%. Going to page 5, I have provided just some rent comparables, and the subject actual rents end up working out to $1,244.79, and we're coming in here at $1,204.74. And then that does compare with other properties as well. And then, so the cap rate evidence we had touched on already, where we have kicked out those sales. So I don't think I need to go over it again. Going down to, I have just provided the income statements here from 2020, 2019, and then on page 13 provided a income and expense workup. So just to show that once we made some adjustments to the income and expenses, our model comes in again at 594,539, whereas once we've stabilized their revenue and expenses, we were getting a net operating income of 616,208. So we feel pretty confident here with our model value that it's coming out with. And then just looking forward, just some pictures I was able to gather online of the interior corridor of the property. So, and that would be the presentation.
Thank you, Mr. McCullough. Mr. Newfield?
Page 4, assume this is model generated. Is this what you're relying on for value?
Yes.
Those are my questions.
Thank you. Ripple?
Yes, I'm wondering, for the pictures themselves, would you have any idea as to when those were taken?
No, I don't know when they were taken. I just had gathered them off their website.
Thank you. Looks like Christmas.
Yeah, fair.
It's not outside. It's
Some
really
years.
right now.
I thank you, Mr. Mahone.
No, thank you. I have nothing.
Okay. So, I have none, so Mr. Newfield, the floor is yours.
Thank you. Well, I take exception with the assessor's workup on page 13. Our own calculation was very, very close to their model, and just thought it would. I think our people felt it was just, rather than dispute a few $1,000s in difference, we'll just deal with the model, and it's a cap rate issue. The building has a lot of good qualities, and one of which is its location. On the downsize side, and it has parking, but on the downside is just age-related deficiencies. Probably if it were a bit newer, it would rank a bit lower. On page 3 is comparable that I was going to quote when we looked at. This is a 3-story walk-up in St. Vital, which has probably set the mark as to the lowest cap rate of a good property in Winnipeg. And this is a Collier's flyer. So Brian and Ron and Don did the valuation on this, and then it sold for 18 million. The cap rate is 5.49%. So that sets the low water mark for cap rates in Winnipeg, a real sale of a good asset. And we were looking for the same number for 800 Coronet.
That's it, Mr. Trickle?
Yes.
Okay, I thank you. Questions of the applicant?
Yes, please. You mentioned some age-related deficiencies. Is there anything in your brief that the board could analyze when reviewing this property to confirm or quantify that statement?
Well, the original age is 1971, and it has indoor parking, and that indoor parking is made with concrete reinforced by steel. The amount of repair work required in our climate for that sort of facility is probably the big downside. On years past, with the high degree of salt and the erosion that occurs in these inside parkades is the major concern here. So I think it's just common sense on that, but for that reason that they may be looking at more R&M down the road, or have to budget for it.
Okay, just in regards to the indoor parking, for a property like this at this age, would you consider the inclusion of indoor parking a net benefit or a net negative cap rate wise?
Cap rate wise, it's a negative as opposed to outdoor parking because of you essentially, when you build something, you have a wasting asset. If you don't build something, it doesn't waste. So land is going to cap better than a structure because the structure wears out, land does not. So it's a negative as opposed to other forms of parking on a cap rate perspective.
Okay. So income wise, is indoor parking a net benefit or positive income wise?
Well, it's going to generate more income, but we've already looked at that and agreed to that the numbers will be higher. You just have to have a higher cap rate to account for like I said, it's a wasting asset.
Okay, and then I'm trying to find 333 Ward here. Is that on? Okay, page 3, 333 Ward. You mentioned that analysts in your organization did work to come up with a cap rate. Do they use your interest rate, your financing methodology? Or do they use stabilized income and expenses?
They use the actual performance of the property to calculate the cap rate.
Okay, and in
They
regards,
use stabilization methods, of course.
okay, and then what's the date that this sale transacted?
I think it was late 2015 or early 2016.
Okay, so that would be would you agree that's a very different financial climate than the reference date we're looking at now from a borrowing and lending standpoint?
At that particular point, I'm just trying to recall. No, I don't think we're going to see major variances. Rates were on the way down. You know, they did bottom out at one point in time, but the transactions during the bottoming out period are very, very rare. Right now, they're on the way back up. I think it's fair at the time.
Okay, and this sale it didn't go through land titles, did it?
I'm not sure if they did a title name sale after the fact, but the initial transaction was a share sale.
Okay. And, do you know who the players were at all on this?
I have that somewhere. I don't have it in front of me. But there were no considerations as to the balance sheet that were involved. There were no retained earnings issues. There was no deferred expenses that could be claimed later. That the tax considerations were zero.
Okay, so there's no REITs involved in this sale?
The sale, no, I thought. Yeah, I don't want to say no. In our viewpoint, it was properly researched and properly verified, so that any sort of impact of unreliability was removed.
Okay, and then just one more question on 333 Ward, then I'm done. Are you aware that the department and members of the panel in seasons past have seen this property stabilized around 5%?
No, they haven't. That's the dispute. What they've seen is that Alta's prepared a report on this property not knowing what the sale price was, and then produced a report that indicated it was 5%. And no one ever, they never knew what the actual sale price was. Now, Sid Story did find out what it was, and he presented it as 5.5% because he knew the players involved. I'm only presenting it for the first time today because Brian Talia waived the confidentiality due to the time limits, and our company did the sale. We have a contract at 18 million. And I think other people were reporting it at 18.5 because it just didn't know any better. And that's lack of verification on the fault of the other parties.
All right, those are my questions. Thank you.
Thank you, Ms. Rempel.
I have no questions. Thank you.
Mr. Pahone.
With the confidentiality of the sale on Ward being waived, does that mean that the contract will be available for perusal?
I can check on that. I think we need what I could waive was the Colliers portion of it because that was fine. So now I have to see if I think that requires the purchaser's approval as well as the vendors. I'm not entirely sure. So that would be interesting. I'd like to see that.
I might be interested too, but not for today. Anyway, thank you. Thank you. My only question. Okay.
Summation, either party?
No summation.
Okay. Let's go to 503 Corden Avenue. McCulloch, whenever you're ready.
Yep. Okay, so we have file number 221935 and roll number 120-21555-000. The roll year is 2023 and the assessed value 610,000 with a classification of 20 and liabilities T, taxable. So we have one building that's 2 stories, actual year built and effective year built are the same at 1953 with 8 suites and construction of wood or steel framed exterior walls. So scrolling to page 2, we have the location here. So you could see it is located just off of Pembina Highway West. And if we go further, we'll bring you to the income workup on page 4. So we can see the average monthly rent per unit is $800.80, with our effective gross income coming in at $73,648, and expenses at 42,532, which would bring us to a net operating income of 31,116 and a capitalization rate of 5.10%. I've included the rent comparables here, so you could just see where the subject falls in line with other similar properties in the area. Capitalization rates, we've already gone over that. I've included the mailer here on page 8. And it is a combined mailer with the other property. The property of 507 Gordon Avenue. So when we stabilize the R&M at 1,500 per unit, management at 5%, the difference when we divide by 2 on the income and expense would be pretty close to the applicant, as you will see going forward in their brief for NOI. So that concludes our presentation. We are open to questioning.
Thank you. Mr. Newfield?
I'm looking at page 10. I think that's an error there on R&M at 55.58 per unit. I think you were dividing that by 8 instead of 16. See that?
Yeah, that would have been correct then.
Yeah. Okay. Because so your numbers aren't necessarily correct. I mean, because they've submitted a income statement on the 2 units, and I guess sometimes it's confused. Then you don't always do the division.
Fair.
Okay. And does the model, which I'm assuming is a workup, have any distinction on unit size or number of units in a building?
Yeah, encapsulates the number of units in the building. In our system, we've got 4 bachelor, 4 1-bedroom for each, and then on a gross floor area per basis, it's compared, because we don't have the unit sizes themselves for every building. We just have the gross floor area.
Yeah, no, I was just the number of units. So what's the adjustment then? Do you know it?
I'm sorry, can you?
You said the model makes an adjustment for units, number of units. Do you know what it is? Negative, positive, breakpoints?
Sorry, can you? When I said that.
Maybe I misheard you.
Yeah, I'm not sure what you mean by that. This income statement, like you and I had this one last Thursday.
Right.
So basically, we saw that they're sister buildings, they're reported together, but with individual PIDs, each building's got 4 bachelor, 4 1-bedrooms. So we were able to effectively, without any differences between the building on a record, we were able to discern actuals on a building per building basis by simply dividing by 2.
Right. No, but that wasn't the question. I was asking about the model and whether the model made a distinction on rates based on units, number of units.
I'm not sure actually.
Okay. Those are my questions. Thank you.
But thank you, Ms. Ripple.
I have no questions.
Mr. Mahone?
Just one, the sister building was the subject of a board hearing last week. Is that,
Yes.
did I hear that correctly?
Yes, we discussed it last Thursday.
Thank you.
All right, Mr. Newfield, the floor is yours.
Thank you. And for the record, I have no idea what the board decided, but I don't care. the 503 and 507 are separately titled. So they're separately marketable, but the expenses are, most of them are joint. I think there's like one water meter. I think there might be two electricals. I'm not sure about the gas, and all the maintenance costs are, they hire someone to do something. It's the whole thing. So I know the department doesn't have an issue with it anymore about separate statements, because the difficult point here would be is that if you estimated the expenses yourself on it and then provided it to the board, then somebody, not Mr. Baracus, would come and make an accusation under 56 3.2 about providing misleading information or different information, because we're estimating. So we give the owner gives the assessor what they have in their care and control. So it's a bit confusing sometimes. But our NOI, for example, is joint NOI, and half of that is for this building. That number is $29,203. And we've capped it at, so that's a minor difference from the assessor. And, I only talk about the bad things, and that's not because I just want to spread doom and gloom. It's we have a model, and the model is optimal, and we have to tell you where this differs from the model. And the negative on this is that the R&M is a bit higher than a larger building because of its smaller number of units. And so the assessor's number is $31,116. We're $29,203. That's $2,000, and I believe you have to look at can't make more money. The cap rate we selected is 6%, and overall, this is a fairly good building, and nothing major that's wrong with this. The same owner as 597 Broadway, so they've got good buildings, they got bad buildings. So the issues we have with this are small. The optimal rate's 5%. The closing cost adjustment, which we always do because that's a Collier's cap rate. The fact that there's only 8 units is negative, because if you're treating this as an investment property, an investor would like a greater unit base to spread risk and expenses. Say, for example, you have one vacancy in an 8-plex, that's 12%. But if you have one vacancy in a 50-plex, that's 2%. And that's why in investment side, we'll penalize smaller units. Now, there's some argument that some would say, and you're going to get this question because Matthew and I have been rehearsing, is that, well, would somebody be more interested in a smaller investment they could afford to get? True. But then it's not the income approach anymore. It's different motivation. If you're going to use the income approach, you have to deal with the income issues, not on different motivations. So the small unit side heightens the risk, and this is very slight adjustments. And then the design and layout. Being on Corridon for bachelors is not really a good thing. I think the perfect mix is always 50-50, ones and twos, 1 bedroom, 2 bedrooms. So you'd like to see more of the larger units, and that also gives you more income flexibility. Like, for example, as a renovation project, no one's really interested in renovating bachelors. You are interested in 1 bedrooms and 2 bedrooms because then you can get a better money on the market for them. So and the reason is quite simple. You can get a double income family or grouping in a property, 2 people paying the rent, and therefore you can get better rents. Whereas a bachelor, you're generally stuck with a single occupancy, single income. These are all just common sense factors. And then other than that, just age related deficiencies relating to, having been built in 1953, you're going to have more problems than it was built in 2009. Overall, I think the cap rate at 6% is fair for this property, and that's my presentation.
Thank you. Mr. Assessors, any questions of the applicant?
Yeah, a couple questions. On page 2. When I'm just looking through your chart here, I see that you have location 10 out of 10, income growth potential 10 out of 10, tenant strength 10 out of 10, and income stability 10 out of 10. Do you think that a 6% cap rate, given all those factors, might be too high?
Well, no, because remember, we're weighting these factors. So these aren't small time factors. On the big numbers, they do very, very well. What this property, where its deficiencies lie, are on about 5 of the smaller factors that keep it away from being optimal. And remember, bear in mind that optimal is going to be in the mid 5s. And so we're not talking about major deviations from that.
So when you say optimal is in the mid 5s, on page 23, it shows your Collier's Q1 21 cap rate report by Rob Perteau. It says low rise, low is 5, high is 6. So would it be fair to say that you placed this property at the top of the Collier's analysis?
No, this would never be a prime property because we've got the descriptions of the prime property on page 24. So you get 5%, high rise, multifamily residential buildings with high densities, typically exceeding 4 stories in height and including elevators, concrete construction, amenities such as underground parking, fitness rooms, pools, tennis courts, social rooms, etc. That's a 5. This is a 5.
So looking at page 23, Rob of Collier's predicted in Q2 that the cap rates would drop. It says Q2 prediction HL, I assume that's high and low with downward arrows. Is that correct?
Well, that would be post reference and a prediction. That's was just a statement he was making. I don't know. I'm not even sure if he prepared this or he just had his name put on this. But let's see, what does it say? Multifamily transactions have been steady, with owners taking a buy renovate approach to increase rental rates. New construction has been active. I think you wrote that.
Okay, so then on page 24, just looking at the glossary here, says that cap rate is a property's net operating income for 12 months following the date of sale divided by the purchase price. So they don't use, so just to be clear, they were using direct sales on this, or were they using the financing formula that you presenting today?
Well, every person who participated in this report, and I've only given you the Winnipeg page, I think there's 10 or 11 pages, the respective market would generate their own numbers, and they would do it based on their own observations of the market. The brochures, I guess, generally intended to be an advertising tool. And so if you want to know what Rob said about cap rates, then I would refer you to, which I have not entered in evidence as primary evidence, but rather as rebuttal. In rebuttal cap 3, pages 47 to 50, were the rates that I believe were sourced from him.
Okay, I was just asking because this doesn't. I just see Collier's presenting they're stating 2 different methodologies here, so I was just trying to.
Well, no. I mean that's not fair what you're saying, because what I told you was we have actual cap rates and then we vet them and then we use them in capital markets to vet them, and we throw out ones that don't meet that are not real rates. And they would be where there's creative financing involved that can't be adjusted, or where it was a renovation project. Because we have a reasonableness test.
Okay, and then, as you predicted, in regards to we did this one already. In regards to the overall size and valuation of the property, would its relatively lower market value compared to other multifamily investments generate a larger pool of potential investors, including smaller ones? And would that not have an effect on the cap rate?
Well, the issue there is that when you change your pool and you attract people with less money, I'm not going to call them different investors. I'm going to call them people with different motivation. And then you have to go back to investment and the definition of investment value. What do you really want out of it? So if you have somebody who has a bit of pension money and sees that he's getting 1% at the bank and he has a chance to make more in a multifamily project, that will be his motivation. But that is not how valuation is to be done for multifamily. You're now not doing an income approach. What you're doing is a personalized approach. An income approach has to satisfy the money markets. And that's where everything's gone wrong this year. You still have to satisfy the money markets. The individual motivations are the anomalies. They get tossed out. So, and the other thing about the smaller user is that there's usually an element of owner occupancy that is in their mind for the smaller units. Whereas perhaps, I myself was in a situation where I thought I could buy a fourplex because I needed a place for my mother, and then my sister was going to move in to look after her, and that was just going to solve my guilt, my son's guilt on not looking after my parents. And I would pay more for that. And I would say that if someone wants to use it as a cap rate, that would be wrong.
Okay, and just in light of Colony being at 6.2 and that valuation being accepted, you still think 6 for this property on Corden is correct?
Valuation's imperfect. You gave me a reasonable offer. I know my client would have accepted it. I would have argued for more, but it's close enough. And I don't think we rank him in that way. And we're also looking at thresholds here. Again, it's not, there's got to be a sanity threshold for investments. And the sanity investment is having enough money to pay the mortgage. You will not get a CMHC on something like this. You're going to the bank and you're getting 3.5 points probably in the reference year, which means you need a 6% return just to pay your mortgage.
Okay, those are our questions. Thank you.
Thank you, gentlemen. Ms. Rempel.
I have no questions. Thank you.
Thank you. Mr. Mahone.
Just to be clear, there are no patent defects with respect to this particular property, like its foundations, or we heard a lot about the ongoing foundation issues on Broadway. I don't see anything here, and there's been none mentioned.
No, I think the defects, I just the repair and maintenance is higher because you're looking at small unit count, and in my analogy, it's always the doors. There's 2 doors in this building, and there's 2 doors in a 40-unit complex. Someone breaks one, costs you the same amount of cash, but distribute over 8 units or 40 units, and therein lies the high maintenance costs.
Thank you.
Thank you. Either party wants summation?
If we can get a 2-minute break, that'd be awesome.
Absolutely. Call a hearing back to order. And we're gonna go to 195 Wentworth Street. So Mr. Mikulik, whenever you're ready.
Yes, so file number 222701, roll number 12022918 0.000. Roll year 2023, assessed value 1,695,000. Classification 20 and liability taxable. We have one building, 3 stories. The actual and effective year built are the same, 1913, 15 suites, and construction, wood or steel framed exterior walls. Location is located on Wentworth between Grosvenor and Corden, so very close to the previous properties that we had just been discussing. And so we have our value summary here. So rents are 1121.58 per unit. Our model workup comes out to a net operating income of 88,135. So I'm just going to glance you to the last page where we did an income and expense workup on page 11. So once we did our stabilization, the model, we're at 88,135. We came out with a net operating income on stabilization of 86,766. And just glancing ahead, the applicant was also in line with that net operating income as well. Very close, we're within 0.5% of NOI. So it's really going to be a cap rate issue. So from our end, that concludes the presentation, and we'd be looking for questioning. And just to clarify, we did use a 5.2% cap rate. I know I didn't touch on that earlier. It's a 5.2% modeled cap rate. So
Thank you. Mr. Newfield?
Yes. So what you're relying on is page 4, and that was model rates, correct?
yes, that's correct.
And just, I mean, I see your work up here and you arrived at a slightly different number, but again, the question is, why do you change the management fee and reduce it, but fail to put in professional fees or office fees? Did you not think that maybe those fees were reported by the owner in the management number?
I would just say that I'm only using actuals that are recorded, so I'm not going to get into the basis of assumptions on what those numbers may be.
But aren't you already assuming I mean, isn't there a line item in the model for management for professional fees and office supplies?
I'm not familiar on what exact numbers are used in the model.
Okay. And in the capitalization rate, you have this or the model has it at 5.2%. Now, this was built in 1913. Would you not think that some investor would say we must have a bit higher replacement for reserve considering the age or risks down the road because of the age?
Possibly, yeah. I mean, you could make the assumption.
Those are my questions. Thank you.
Thank you. Mr. Retzel?
No questions. Thank you.
Thank you. Mr. Mahone?
No questions.
I have any other than there's no parking to the for the subject at all.
No, they don't have any parking reported.
And the 1913 that was built, it hasn't gone any doesn't go into an effective age or anything like that. Like no improvements at all.
I haven't personally inspected the property, so I can't really say. Maybe they have done some, but nothing that I could speak on right now.
All right. I thank you. Mr. Newfield, your presentation.
Yes, thank you. So yes, there is a small difference in the income, but I will state again and again and again. You don't make up and adjust these incomes. It is what it is because everybody's different. And to have somebody tell you that at their desk, they decided this expense is out and this one is in is not the way you do adjustments. You go down and find out what happened. So we're relying on the actual NOI, which we balanced as we normally do with the last year's income and an average of 3 years of expenses. In this case, the information was strong and reliable, 86,449. As far as the cap rate is concerned, we keep saying 5% is the optimal in our Collier system, which is really 5.15 when you correct for closing costs. The configuration, this is kind of a thermal issue more than anything else. Now you see the picture on page 1. There was a bylaw. I don't know if anyone's ever heard this before. There were a lot of fires in the pre-war era on wood frame construction. So bylaw came out in 1912 saying you could have no more joining walls between units without I had to be on an exterior wall or a hallway. So if you see any building built from 1913 for a couple years onward, they'll be designed like this. You see how they've got a common hallway in the building, 2 separate buildings. So each unit is on the exterior of the building because of this 1912 bylaw. It's just an interesting issue. It was amended later after more fireproof materials came in and were available. But with the wood frame era, this is what you saw. Now the problem is it's a thermal problem right now. You just have more exterior facing space. Tell you the best building I've seen done on a 626 ward law where they made it like a star. But I digress. No, it's related, and the factor where we're concerned a bit is just thermal loss. Now most of these buildings have steam or boiler heat, so it hasn't been a problem over years, a major problem. It is when you switch to fossil fuels, it costs a lot more. The parking was brought up, no parking. So the reason that this is a negative factor is you limit your users. You're dealing with people who probably can't afford a car, so can they afford rent? And that's in the simplest possible way I can say this. Your appeal is going to be to a different socioeconomic class. Of course, in this day and age, now it might be a more environmentally conscious group of people who decide bicycles are the best way to go. Regardless, it's a broader appeal is a bit, if you have parking, you have a broader appeal and you have the potential for earning more. But the same issue with the building size, these are minor issues. That's a 0.15 deduction from a 6 to a 3, and it's a low unit count. And where this materializes is the differential R&M rates. You know, 1 year is 20,000, and next year it's 40,000, because if you have single costs, they don't get spread out. So it's just a lower risk level. 30 units is always, in my mind anyway, it's always been the minimum for a good operation. And after that point, the difference in unit sizes isn't a major factor. Year built 1913, I think that's obvious. You're dealing with issues with building code and upgrades and an asset that's 109 years old. So there's going to be different maintenance required with the quality condition as well. And otherwise, it's a great location and it's a beautiful looking building, and the investor is going to be worried about his expense load on this building, and we think the 6.25 is fair. And I have some closing comments.
I thank you. Mr. Assessor, is any questions in regards to the presentation?
Yeah, so locationally, would you not agree that Corridon area is a better investment location than, say, a property in West Broadway?
Overall, Corridon is better, but remember, there are grades in each area. So there's Corridon with parking, Corridon with no parking. So, and they are different grades as well.
Okay, just one more question. In regards to optimal suite mix, what would you say the optimal suite mix of bachelor, one bedroom, two bedroom, three bedroom would be?
Optimal would be 50-50 ones and twos.
Okay, thank you. Those are our questions.
I thank you. Ms. Rempel?
Yes, I'm looking at this picture you provided on page 2 of your presentation, and there's a for sale sign.
Yeah, I'm puzzled by that.
And do you have any sales information on this property?
No, Smith has owned this since probably the day it was built. I went to their 100th birthday in 1912, and they were talking about dredging their basements with horse-drawn sledges on Corridon. I think they've owned it since then, so I'm not. Is that a for sale sign? It looks like it, doesn't it?
I don't know, is it a for rent sign? I can't tell.
Yeah, I could look on the phone now and see what it and zoom it in. I don't know. Like I said, this is owned by Gopher, and Gopher is Smith's original investment company. Later on, they had another one called United Investments. So Gopher are the older ones.
I just blew it up. It looks like it's full rent.
For rent? Yeah, okay.
That's all my questions. Thank you.
I thank you. Mr. Mahone?
No, I don't think so. Thank you.
Oh,
I just have a couple of questions. Have you been through this building?
I have, and I don't remember when. Yeah.
Got a boiler system? Probably.
Yeah, I don't know if it's steam. Yes, it's boiler. I just don't know if it's steam or water. Yeah. You know, you can easily tell by looking at the heating costs. 18,000. Yeah, I mean, I think that's boiler heat. Steam would be a bit less.
How do you get a cap rate of 6.25?
Well, you know, we just look at the optimal and take out deficiencies that we noted, and you know, it's detailed what we thought were the deficiencies: the parking, the age, or the nature issues. And that's because, you know, the parking is an impact on the ability to earn, and the age is an impact on risks down the road. So an investor's going to look at it and say, I'm buying a 109-year-old building, what's going to go wrong in here?
And the expense ratio of 57.4%, that's, you know, for a building that's that age, that's pretty low.
Yeah, I think it's a good ratio because, you know, some of the other ones that you saw, well, Colony never got really reviews, but Colony and Broadway, same ownership, and they were up at 70%. And so, and this is a reasonable rate.
Okay, I know you want to say something, so I'll go to the assessors for summation.
Yes. One moment, please.
Yeah.
Okay, so it's just like when we're looking at this property, it's the applicant has presented a 6.25 cap rate, and then when I look at their, I believe it's their page 2, with their optimal and subject and reason columns, rows, I see location 10 out of 10, access 5 out of 5, site size, topography, all maxed out. As with land use, exposure, design layout, income growth potential, tenant strength, and income stability, all maxed out. Coming up with a 6.25 cap rate, which is higher than the high end on the Collier's report on page 23. I just don't see the connection there. Maybe it's a methodology, financing versus direct sales stabilization.
No, it's,
But no, they're just closing comments here, not.
oh, closing, I'm sorry, you were asking a question, okay.
No, just closing comments.
I've heard it before, and it was always a question before. So
Yeah, to me, those, it just doesn't jive how the property on Corden with these admitted good factors going to it ends up higher than the high end of the low rise. And it is old, no argument there, but those two just don't jive in my opinion. Thank you.
I thank you. Mr. Newfield, final word?
Yes, thank you. Well, firstly, just revisit what I said earlier, actuals versus projections. No one's buying a property based on projections like a model or something like this. They're going to be looking at the experience of the property, and that's how they're decided in the marketplace. And they show the greatest proof of what the property can earn, and the assessor's adjustments were a little bit arbitrary. For example, we don't agree with the management rate, but we're not going to put in the other expenses. Well, this particular client that they were looking at is a simplified approach. All the costs related to running the property are put in one category. They don't have a breakdown. So you know what? There's paper in there, and there's staples in there, and there's accounting fees in that costs. So that's what they're doing isn't right. And I don't think they should be presenting it the way they do, to say someone at a desk has worked out what the income really should be. You can verify it. You know, look, Rhonda Martell's signature is on there. Call her, ask her. The cap rate is been oversimplified, and there are numerous factors in a cap rate, and you know, I appear before this board 5 months out of every 2 years, and I get on my soapbox and I tell you what's wrong with the model. The rest of the time I'm out there doing work and appraising properties. I'm an accredited appraiser. I'm now National Director of Specialty Properties for Colliers or something like that. I don't really put much weight in titles, but the point is it's a great responsibility, and it has something to do with my abilities and my knowledge. And I'm not bragging, I'm simply saying I'm not a junior in the back room making stuff up. This comes from real work, real life experience. I know what a cap rate is, and it's got to satisfy the investors, the banks, and it's got to make sense with the money markets, and is complicated. It's not an invisible thing that the assessor says, well, the model generated it. You know, you imagine I said that to a client, yeah, my model spit out this cap rate. Bank would laugh you out. You got to be able to do it, and you got to analyze it properly. And it's got to be a relationship. So I was this morning, and this is always troubling me, because I've got to tell you, this year I'm feeling like I'm a lone voice in the wilderness here. I Googled misleading cap rates. And it was interesting. I just came across this article, and this is argument, not evidence. But you know, this came from a guy in North Carolina, and talks about that a cap rate is the same principle that gives you a lower return for low risk assets like treasury bonds and more.
I'm sorry, can I make an objection, please? I believe this falls under the scope of new information.
No, this is argument. Well, you've already heard this. This guy's saying, I told you that there's a money market link. This guy's saying the same thing. There's no new evidence here.
Do we have the report that you're reading right now?
I can file it.
Well, I'm going to let the panel make the determination. on this one.
But
I can raise the objection, but ultimately it's the
I'll
panel.
be finished by now.
I know, fair enough.
We'll let him continue, okay? There's just some minor points there.
Okay,
It's not new evidence or anything like that, it's just comment.
okay,
Well, low cap rates means investors and property owners are willing to accept lower income returns because of lower perceived risk, just common sense. Economic and demographic fundamentals of markets are different. Locations economically not as strong as a growing big city that has a diversified economy would have a different rate. So we're talking, you know, are we living in Vancouver or are we living in Winnipeg? Cap rates increase as you move to lower property classes. Now, the one quote I just found this is exactly the same thing I've been saying here is if you feel you want to accept a cap rate of, I won't say the number because that's evidence, today, you can do it based on prices and rent for a property in a nice location where value will continue to appreciate. So a low cap rate means you're going to get more money as your property increases in value, and we're not in that market. And by accepting cap rates so low, you produce no income today. Your growth and it depends on outside forces, not the market, not the income approach. It's something else that's driving it, and that's really what I saw here that I thought was really an interesting statement. Is externalities.
All right. I thank you. We'll go to the next one that we have on the docket, which is 765 Ellis Street. So,
What do you want me to do for my portion of that? Do you want me to withdraw, or do you want me to?
well, you know, it's up to you. Let's just listen to the presentation by the assessor. McCulloch, whenever you want, you can take us through this property.
Okay,
Then we'll deal with it.
yep. File number 22.
I don't think I have standing here, actually.
Pardon?
I don't think I have standing. I think I should withdraw. Because Trevor's already had this heard,
That's right. So if you want to withdraw, we'll get you to sign the withdrawal.
Yeah.
All right.
I think it's
But
appropriate.
if you want to do that, then you were going to be finished.
Yeah.
Okay. So
I can go.
yes, I know. But in the meantime, do you want to listen to this?
No.
No, I know. Okay. Let's just take about a 5-minute, a 2-minute recess, okay? So we'll do the formality of the withdrawal, then we'll go through the property, and there's a recommendation on it, but it's applicable to Mr. Smith. All right,
okay,
Yep.
so bear with us.
no problem.
Trevor, Stephen, if you don't want to shut it down, it's fine. You know, if you,
We'll go into a recess.
Okay.
Stepping away for
Okay.
once I get that one.
we'll take 3 minutes. We'll call the hearing back to order.
Maybe we.
Mr. McCulloch, you can take us through 765 Ellis, and if you want to abbreviate it, that's fine.
Perfect. So file 223694, roll number 13031780000, and we have a recommendation to reduce the assessment to $2,569,000 using a cap rate of 5.8% and a net operating income of $148,979. And that will that will pretty much be it. Trevor was spoken to yesterday, took the recommendation, which would be assumed why he's not there today.
Can you give me that figure one more time?
Yeah.
5 billion.
It's 2,569,000.
And this has been conveyed to the applicant. And the applicant, it's my understanding that he was here this morning and has accepted.
Yep.
Panel members, any questions?
No question.
No, thank you.
Okay. Well, this morning we've heard all the scheduled items and this hearing is officially adjourned. So gentlemen, thank you both. Have a
Thank you.
blessed day
You
And a
too.
good weekend.
and a good weekend.